the secret engine behind mega property deals. Have you ever wondered who actually funds those massive skyscrapers, luxury hotels, or billion-dollar shopping malls? Behind every massive real estate deal, there's an invisible financial engine that most investors never see. It's called real estate investment banking. This world is where finance meets property at the highest level. It's where large developers secure hundreds of millions of dollars, where pension funds invest in giant office towers, and where investment bankers structure deals that transform empty land into thriving cities. But here's the surprising part. Most everyday investors have absolutely no idea how this system works. They see the final building, but they never see the financial strategy that made it possible. Understanding this hidden system can completely change how you think about real estate investing. Because once you see how institutional money moves, you start recognizing opportunities that small investors usually miss. So in this video, we're going to break down what real estate investment banking actually is, how deals are structured, and why understanding this world can make you a smarter investor. Let's start by uncovering what investment bankers actually do in real estate deals. When most people think about real estate investing, they imagine buying a house, renting an apartment, or flipping a property. But real estate investment banking operates on a completely different scale. Instead of buying a single property, investment bankers work on deals involving entire office towers, shopping centers, apartment complexes, or even portfolios worth billions of dollars. Their job is simple in concept, but incredibly complex in practice. They connect capital with real estate opportunities. Imagine a developer planning a $500 million mixed-use project. They need investors, lenders, and financial structures that make the project viable. This is where real estate investment bankers step in. They analyze market demand, structure financing, raise capital from institutional investors, and sometimes even help sell the completed property. In other words, they act as the financial architects behind some of the largest real estate developments in the world. And while it may sound like a world reserved for Wall Street insiders, the strategies used in these deals can actually teach everyday investors powerful lessons about risk, leverage, and market timing. Let's explore how these massive deals are actually structured. Large real estate projects rarely rely on a single source of money. Instead, they're built using something called capital stacking. Think of it like layers of financing. At the bottom, you typically have equity investors. These are the people or institutions that actually own the project. Up above that, you have mezzanine financing, which acts as a hybrid between debt and equity. Then comes senior debt, usually provided by banks or institutional lenders. Real estate investment bankers design this entire structure to balance risk and return for everyone involved. Why does this matter? Because the structure of financing determines who gets paid first, who takes the biggest risk, and who stands to earn the highest returns. For example, senior lenders receive lower returns but carry less risk. Equity investors, on the other hand, take on more risk but potentially earn much larger profits if the project succeeds. Understanding this hierarchy helps investors see how professional deals manage risk while still aiming for strong returns. And it's one of the most important lessons everyday investors can learn from institutional real estate strategies. One of the biggest surprises about real estate investment banking is who the investors actually are. It's not just wealthy individuals. In fact, the biggest players are often pension funds, insurance companies, sovereign wealth funds, and institutional asset managers. Why? Because large real estate projects offer something these investors love: stable long-term income. Office buildings, apartment complexes, and shopping centers can generate predictable rental cash flow for decades. This makes them ideal investments for institutions that manage trillions of dollars in long-term capital. Real estate investment bankers act as the bridge between these massive pools of money and developers who need funding. They pitch deals, structure partnerships, and help institutions decide where to allocate their capital. For everyday investors, this reveals something important. When institutional money flows into certain cities or property types, it often signals strong long-term demand. Following these capital trends can provide valuable clues about where the next big real estate opportunities might appear. So why do investment banks dedicate entire teams to real estate? Because the industry offers huge transaction opportunities. Whenever a property is financed, refinanced, sold, or taken public through a real estate investment trust, investment banks can earn significant advisory and structuring fees. But it's not just about fees. Real estate is also one of the largest asset classes in the world. In fact, global real estate is worth hundreds of trillions of dollars. That means constant deal flow, acquisitions, developments, restructurings, and portfolio sales. Real estate investment bankers analyze markets, forecast demand, and structure deals that align investor goals with property opportunities. And while most individual investors never operate at this scale, understanding these dynamics can help you see the bigger picture. Because real estate markets are often shaped by institutional capital flows, not just individual buyers. Recognizing where big money is moving can give you a major advantage when evaluating property investments. You might be thinking, this sounds interesting, but what does it have to do with my own investments? Actually, quite a lot. Real estate investment banking reveals how professional investors think. They analyze demographics, economic trends, infrastructure growth, and long-term rental demand before committing capital. They also diversify across property types, residential, office, industrial, hospitality, and logistics. Another major lesson is risk management. Institutional deals are carefully structured so that risk is distributed among multiple investors and lenders. Even if a project faces challenges, the financial structure protects different stakeholders in different ways. For individual investors, studying these strategies can help you approach real estate more strategically rather than emotionally. Instead of simply buying property because it feels like a good deal, you begin asking deeper questions. Who else is investing in this area? What economic trends support demand? And how is this investment financed? These questions can dramatically improve long-term investment decisions. Real estate investment banking may seem like a world reserved for large institutions and Wall Street professionals. But the truth is, understanding how these deals work can give everyday investors a powerful advantage. Because once you start paying attention to where institutional capital is flowing, you begin to see patterns in the real estate market that most people overlook. You start noticing which cities are attracting development, which property sectors are growing, and where long-term opportunities might exist. And that knowledge can dramatically change how you approach investing. Remember, the most successful investors aren't just buying property. They're studying the systems, capital flows, and financial strategies behind the market. If you enjoyed this video and want to learn more about finance, investing, and the hidden strategies used by professionals, make sure to subscribe to the channel. And let me know in the comments, what real estate topic would you like us to break down next? Your ideas might inspire the next video.